Hey everybody, this is Chris again with Hotspot Metals in Chicago, and you may have a question for me, and that is with the horrible looking silver chart and silver action, what the heck am I doing buying silver? And I thought I'd just talk about one of the reasons. So don't go away from this video saying, well, this is why Chris is buying silver. It is one of the reasons, and it's a rather macro reason. It's the root of the reason why I always buy silver. I'm saving in precious metals as opposed to pieces of paper with dead presidents on them. So we're going to look real quick. We're going to zoom way out. Sometimes I say the chart on my live charts page, the 15-minute chart, that's just for fun and giggles to see the little blips up and down. And I say zoom out to the daily or zoom out to the weekly. Let's see where we're at, where we're going right now. Well, now what we're going to do is we're going to zoom out a few years, and maybe you'll have a little bit of insight as to why not only am I buying now, but I think it might be one of the very best opportunities that anyone will have, at least in my lifetime, to get in on a hedge, some insurance. I know nobody wants to call it an investment, but I'm going to show you why it could be a good investment at this time, because there are times when precious metals way outperform everything else, and sometimes precious metals are the only thing that's performing. And I think one of those time periods might be coming. So let's take that big zoom out. And here we are looking at a chart of silver going all the way back to the year 2000 and taking this nice, slow, gradual move up, which is fine, but I'll be dead by the time I can't follow this trajectory forever, and I don't plan to. We can all see, we all have heard the legend of 2011 when silver went up to 48, and then it's been bad news bears ever since then. However, this steep line here where silver was crashing for a couple of years has been broken, and now we've started to go sideways. Let's look at some of the things that happened over those years. And I'm going to do this really quickly because I don't want anybody to fall asleep. Charts can be boring, but we're going to put a little story with it. It's a little story about a recession, and a recession that started in December of 2007 and ended officially in June of 2009. What's a recession? A recession is 3 straight quarters in a row of negative GDP. And this continued on with negative GDP and lots of loss of homes, autos, marriages fell apart. It was a bad time. Everything was bad. So what did our friends at the federal government do to try to step in and help? All with good intentions. And I'm not going to say it was all bad, but they started doing a little thing called QE, quantitative easing. Much nicer word than just creating money out of thin air and giving it to the banks, right? I like QE better, and it rhymes with QT, which is what we've seen a little bit of for a while. But let's just call it QE for now. But every time I say QE, in your mind, you just envision somebody sitting at a computer, typing in a few more zeros and hitting the send button to the banks, to recapitalize the banks, and to, through a number of twisted schemes, change the interest rate from one where widows, orphans, old people could make some interest on their savings, their lifelong savings, even if it was 8, 9%, something like that. They could live on what they saved at the end of their lifetime. So that's been destroyed now. Of course, I think you can make a cool 0.05% on your savings in the bank, and then along with the inflation rate that's been much higher than what they say, you can basically lose 2% of your money every year, and so all that. Forget about retiring. Okay, so just move on from that. And I'm not sure you'll be a Walgreens greeter either, because Walmart greeter either, because Walmart's closing stores now. All kinds of retail havoc going on. Anyway, I digress. Let's get back to this. We had QE1. This went from December 2008 to March of 2010. Basically, money creation, pushing more capital out into the markets to reduce interest rates, to get guys like me to go out and buy something, gals like you to go buy a new house, a car. All of us stimulate, give us a good deal. Well, that didn't do enough, so we went to QE2, and that was from November of 2010 to June of 2011. A little bit more money, a little more steam. Let's push it in there. What happened to silver and gold? Well, people are like, wait, you're going to keep doing this? You're going to keep printing money? Really? Seriously? Because if there's more money sloshing around out there, isn't it worth less? So some things happened. Gold doubled. Silver quadrupled. Remember that too. Whenever we talk about things really getting on the move, when inflation fears come on board, silver will outperform gold by quite a bit. So, all right, we had fun with QE2. Now we needed more money injected into the system, and we didn't want to call it QE again because that might scare everybody. So we called it Operation Twist. Operation Twist was a little bit different. It was a different way of shuffling the chairs on the deck of the Titanic. What we did was we sold short-term bonds and went and took that money and bought long-term bonds. All these bonds we're creating and buying, we're creating them for ourselves and buying them for ourselves. And what's cool about that is you just kind of add some more debt for yourself, probably when you and your kids are dead and you're out of office and all that kind of thing. But you just push it on to those grandkids and great grandkids, and we'll worry about today for now. But short-term bonds, they mature in anywhere from like 1 to 3 years, and then what they did is they sold those, and then they took that money and they bought bonds that were later maturity, 20, 30-year bonds. Anyway, Operation Twist. I'm no expert. I'm just telling you what they called it. Okay, well, that wasn't enough. So we went into QE3, and this was more bond buying programs where the federal government just got in and bought more bonds, and really it just they didn't have enough money, and the banks didn't have enough money. Rich people weren't able to borrow enough to put Main Street out of business, to keep your wages stagnant. They had to get some more money out there because everybody was loving it. Oh, well, I'll tell you what they're doing all this time, all these red bars here. The stock market was going crazy, and it still is today. And it goes crazy on stock buybacks. And you hear this term, and I think most of everybody understands how this works, but you start out with X number of outstanding shares of stock and they're worth so much, but you're not making revenue. You're not actually making profits. You're some unicorn company. You invented some software that helps people do their yoga exercises or something like that. Maybe not quite that silly. Maybe you're just borrowing money to absorb every grocery and department store chain out there. And it doesn't matter that you're losing money because your stock will always go up when you buy more of your own stock. So you go borrow money, you buy some of your stock, and that leaves less outstanding shares, which means the shares that are out there are worth more. And if you're lucky enough to be on the board of one of these companies or one of the major shareholders, then you get a nice paycheck at the end of the year. And I think a lot of that, a lot of your CEOs and things are compensated on the performance of the stock every year. So which way do you think they're going to make the stock go, no matter what kind of finagling they need? Anyway. Gosh, I'm horrible at this, right? I keep getting off topic. We're all the way up to QE3, more bond buying, more capital injections, and at this point, it isn't working really so much anymore. There's some problems out there, and we see some problems coming down the pike. So we start a regimen of quantitative tightening. Now, this doesn't mean that we've stopped buying bonds or that we're out of the money printing business. We're just going to do it a little slower than we did before, because actually all these QEs really didn't end and begin on these dates. This is one continuum through this period. And why through this period of history do we have all these red and green bars of messing around with the economy? Why not let things just figure themselves out and some healthy destruction, like some banks that made bad decisions and bad loans, maybe they should go out of business? Maybe AIG, maybe some companies that were mismanaged. Maybe Pets.com needed to just go. Well, Pets.com did go away, but there were a lot of other companies too that were way over leveraged and just needed to go away, and the government saved them, and then they later failed anyway. But anyway, we're in this green zone now. Things are getting tighter. We're going to set things right. And we're even trying to raise that interest rate again, which sounded great to me, because to me, normal was what my parents and my grandparents all experienced through their lives. They could make 5, 6, 7, 8, sometimes even more % interest on their savings in their retirement. So bringing those rates up sounded good to me. But then we got to stage 7, which is stage 7 was just last October. They started to raise interest rates, and the stock market started to tank. And this is bad. We don't want the stock market to tank. We can't let the stock market go down, because 20% of federal revenues come from capital gains on the stock market. This cannot fail, and we cannot have another housing crisis. We must keep interest rates low, because think of all the state and local governments that depend on property tax based on all the bedrooms and bathrooms. I don't know how they do it in your area. Maybe you don't have property tax at all, which would be great. Drop me a note, let me know where I can go. And I know there are some places like that. But we are in a too big to fail economy. And honestly, I have my doubts about whether they will let the economy fail, and actually it may not fail on paper because of the digits and dollars required to pay all these debts that the government's built up, and now we're not in any better shape. If we go down here to my next and final slide, look at how interesting this is. Look at the red arrows. This is where you were at the beginning of all this messing around manipulation, and this is where silver was at the beginning of the recession that started in 2007. Look where you are now. I think the only difference here is that these arrows are pointing different directions. You were here, and here you are again. And this red area here, this is the wait, this isn't working area. This is the reversal of the slowdown quantitative tightening era where we were going to start raising interest rates. Now, what comes next? My assumption, the only assumption I can come up with, is that in order to keep the real estate market going, keep the economy pumping, keep the tax revenues coming in, and keep that stock market up, will be to completely reverse, I don't know what I should say reverse, but to completely go back into high gear, creating more money, pumping more money into the system. And look what happened during this time frame to precious metals. Now, this is just silver. This just went from 12 to 48. Gold went from about 850 up to 1900. So this is what the heck reason why I am buying, even though the chart today could not look more miserable. Because if you zoom out and look at the big picture, we could be right at the beginning of another one of these mountains that you're seeing right before you that peaked in 2011. Only this time, there's more student debt, there's more auto debt, there's more consumer debt, and the governments are in debt, and the corporate bond market looks like it could be one of the most dangerous things going now too. And I'm not sure the government's going to be able to save everybody, but one thing I know for sure, they only have one toolkit, and that is to print money. They don't have anything else. You can't create demand. They can't go out and grab everybody and make everybody buy a new car. They can print more money. They can bring the rates down. And if zero interest rate isn't enough, they'll try negative rates. You know, like in Europe, where if you don't spend your money fast enough, you lose it even faster. You're going to pay the bank with negative interest rates to hold your deposits. It's happening now. It's being considered here. It's been considered here quite seriously. And right now, the market is anticipating a rate slash back downward toward that zero mark, and I believe that they may even experiment with going into those negative rates. Anyway, that's one reason why I'm still buying silver when everything looks kind of boring and dismal. Now, 3 or 4 analysts with very good predictive models and they're not just technical chartists. They're looking at fundamentals. They're looking at the charts. Several analysts that I respect because they've earned my respect by being right a lot are saying that we could be right now in the last couple of months setting up for a major move in both gold and silver. I've got nothing to lose by trusting that in part. I don't say, sell the house, sell the kids, go all in on any of this. You should have some. I think 5% minimum. I think 10% of whatever you call your wealth you should have a hedge in silver and gold, because they will perform as fantastic insurance, not only in case of an emergency, but they'll also work as a counterbalance to what may happen with your investments in other assets. So that's my whole point here tonight, just to give you one reason so you don't think I'm crazy. Look at the chart, look how horrible gold and silver look today, and then here's a guy unwrapping a whole package of it. So there you go. There's my story, and I'm sticking to it. This is Chris with Hotspot Metals in Chicago. Have a good evening.